That's why I said it is similar to your ARR. However, the difference between ROI and ARR is that ROI is used to appraise a business. Is used for a business. Why this one is project specific is you use it to appraise projects. That's the difference between the two in terms of their usage. This one is for a project, this one is for appraising the performance of a business. So we can say that the ROI, return on investment or capital employed, is equal to profit all over capital employed. Times 100%. If it's relating to a division, maybe they say calculate the return on investment of a division, we can say that divisional profits all over the division's capital employed times 100%. And know that this capital employed is your net asset, where your net asset is your total assets minus the liabilities. And this, we can also call it equity. It's still the equity position of that firm. So your capital employed, in case if you did not, if you sit for your exam and you see something like this, and the examiner did not give you capital employed direct, it's possible that the examiner gives you things you can find to derive your capital employed, like your total assets minus liability. They can change the name to net assets. They can call it equity or capital invested. Then you know that this is what? Capital employed. Is that clear? Hello? Let's talk. Oh, I like feedback.
Yes, it's clear. But you said total asset minus liabilities, or total asset minus current liabilities. Because if we are saying liabilities, we are saying non-current liabilities to its part.
Is total assets minus your liabilities, both current and non-current.
Well, based on what I know and what I've checked online, it's
Okay.
total asset minus current liabilities, not all the liabilities plus non-current. It's just total asset minus current liabilities.
So where does your non-current liability falls into?
That's in order to ascertain the capital employed.
All right. What are the components of the statement of financial position?
We have the non-current assets, we have current assets, we have non-current assets, and current liabilities.
Okay. Do you remember the accounting equation?
I guess so.
Okay, what's the accounting equation?
Maybe assets plus liabilities. I don't know. I can't remember. Oh, I'm not sure.
The equation is assets equals equity plus liability. And what is making up these assets? Both current and non-current. It is from here that we are able to ascertain the fact that for us to know equity position, what do we call equity position? For you to get this equity, it will be your what? Assets minus liability. And this liability here is both current and non-current. So if I want to get equity from this equation, I will say my equity is my assets minus liabilities. Where this liability is current and non-current. And this equity here, which is my assets minus liability, is the same thing as what? My net assets. So that's where the word capital employed was gotten from. And even the usage of the word capital employed net asset is per adjustments in IFRS. The usage of that word. I know previously, I think previously the major word was net asset, net assets. From time they begin to call it capital employed, capital employed. So it's not only on the current asset, because if we take that away, we are trying to look at the whole thing that make up the statement of financial position as a whole. So if you take non-current liability away, so where do you, if you take non-current, if you say non-current liability is not there, so where do you want to place non-current liability when you are saying, okay, this total asset, this current asset? What about the non-current liability? Do you get my point? Hello? Hello, did you get my point?
Yes, I did.
Okay. Or let me give you another convention. What are the things that makes up non-current liability majorly? What's the major thing that you can find in non-current liability?
Creditors and accrued income. Maybe. Creditors, majorly.
Okay, what makes current liability different from non-current liability?
The outstanding obligations.
There's a key point that makes it different from current liabilities.
Liquid.
Eh?
Current assets are highly liquid.
No, I mean
That you can
for current liabilities and non-current liabilities, there's a one word.
the long term and the yes, we have short term debt and long term debt. I think non-current liability is for a longer period. Yeah.
Okay, we know that liabilities are obligations of the firm or the organization to outsiders. So where the obligation exceeds or is expected to exceed a year, then it becomes a non-current liability. For instance, if you take a loan from the bank and that loan you're expected to repay back in 5 years' time or 2 years' time, that loan in your statement of financial position will be taken as a non-current liability because it has exceeded a year. But whereby you owe maybe a supplier, all those ones are the supplier expects you that you pay within a year. So all those ones can be termed current liabilities. And even your current liabilities, which are your debt of your obligation to outsiders with your non-current liabilities, they are all like an element of debt. They're also having like debt. So it's just like you want to take debt. When you take debt from the total asset that the company owns, what is left is your equity position as owner of that company. And that's where we have capital employed or net assets.
Okay, sir. We can go on. Thank you.
All right. Advantages of using ROI. Advantages of using ROI. One, it is a ratio. I'll just give us 3 points. It is a ratio that is easily understood. That is easily understood by managers as a performance measure. Two, it can be used to compare the performance of divisions of different sizes. Three, it encourages managers to avoid excessive working capital, through effective inventory management. The disadvantage. One, the method is not applicable in investment decision. It's not applicable in investment decision. When you want to, for investment decision, what do you use? You use ARR. So it has similarity with ROI, but ROI is for appraisal of a business, while ARR is for an investment decision. Two, the method relies on accounting profits. The method relies on accounting profits, which are subject to different accounting policies. Residual income. Our residual income is the difference between sales it's the difference between or what did I mention earlier on? It's difference between profits and imputed charge. So mathematically, I can say that residual income is profit minus imputed charge. Here, imputed charge equals where imputed charge equals capital employed multiplied by the rate of interest. Multiplied by the rate of interest. And this rate of interest, you can also call it the cost of capital. The cost, you can call it the cost of capital. Are you with me?
Yes, sir.
Advantages of residual income. Residual income concept takes a long-run view. Of divisional performance. Takes a long-run view of divisional performance. 2, residual income performance. Performance measures are reconcilable to planning decision. They are reconcilable to planning decision using techniques such as MPV.
Sorry, sir.
Yes,
Measures are reconsiderable. What was that?
reconcilable. They are reconcilable, that is, they can be reconciled. Did you get it? Using
Yes, sir.
such as MPV and IRR. Disadvantages of using residual income. 1, residual income, the residual income approach is not so popular. It's not so popular with managers and professional accountants in practice. 2, the problem or we can say that there's a problem of estimating the firm's cost of capital. The firm's cost of capital, especially where there is more, especially where there is more than one Source of finance. One source of finance to the firm. Especially where there is more than one source of finance. Especially where there is more than one source of finance to the firm. Are you there?
Yes, sir.
All right.
So, what do you mean by it takes a longer run of the divisional performance, the advantage of the residual income?
Okay. For residual income concept, the residual income concept takes a long run view of divisional performance. That is just compared to where you have the ROC or return on investment. All these ones can give you, they can measure performance in the short run. But for residual income, you have to look at residual income considers long run view. It takes a long run view in the sense that you are applying a cost of capital on the capital employed. You're applying a cost of capital on the capital employed. And what is that cost of capital to you? The cost of capital to you is like the interest you are paying when you take such debt. Because looking at it, whether you use debt financing or equity financing, that cost of capital that you apply, whether equity or debt, has a duration. So for you to now evaluate how long it will take for you to how long it will take for you to be able to pay back such debt, or maybe reward your shareholders, that can take several years. So for you ascertaining, okay, this is the cost of the equity, this is the cost of the equity, this is the cost of debt, and you applying it to the capital employed, then taking away from a profit to arrive at residual income might be something that might take you a while to ascertain. So for you to be able to ascertain residual income, it takes a long run view of divisional performance. That is, it may take a while compared to ROC. Whereby you can just, is within a short time. Though it's an advantage for residual income. It's an advantage for residual income in the sense that you are able to see your performance in the long run. You're able to see your performance in the long run. You can look, okay, this will be the performance in the next 5 years. But for ROC, ROI, you can actually know your performance even if it is monthly, if it is yearly, since you can directly compute that. You can directly compute that yearly based on the information that you have in the financials. But for residual income, the advantage of it is that it's for long run view. It gives a long run view, not only for a short time, because of how it is computed, since we are applying the cost of capital, which is split into equity and debt. Is that clear?
Yes, it is.
2015, Pathfinder, May 2015. Let's look at question 5.
May or November? May.
May. Question 5. Can someone read for us? We'll look at 5B, question 5B, as it relates to this topic. Let someone read for us.
Carosis Limited make quality wooden products such as tables, chairs, bench, and doors. Historically, the company has used mainly financial performance measures to assess the performance of the company as a whole. The company's chief executive officer has been informed of the balanced scorecard approach and is eager to learn more. Carosis Limited has two divisions, X and Y, each with its own cost and revenue streams. Each division is managed by a divisional manager who has the power to make all investments, who has all the power to make all investment decisions within the division. The cost of capital for both divisions is 15%. Historically, investment decisions have been made by calculating the return on investment of any opportunities, and presently, the return on investment of each division is 18%. A recently appointed manager for Division X strongly feels that using residual income to make investment decisions would result in better goal congruence throughout the organization. Each division is currently considering the following separate investments. We have the capital required for investment, revenue generated from investment, and the net profit margin. The company is seeking to maximize shareholders' wealth. Okay, describe the balanced scorecard approach to performance
Go to B.
measurements.
Go
B,
to B.
determine both the return on investment and residual income of the new investment for each of the two divisions. Comment on this result and take into consideration the manager's view about residual income.
Okay. That's Victoria, right?
No, this is
Okay,
Falashade.
okay, let me hear from another person. For every other person that followed with this question, because one of the things I do say, you would have heard me say it many times, read the story, read it like a story, read the question like a story. So when you see the question in the exam, as far as you attend classes and you have been taught a topic relating to that, you will be able to attempt any question. The examiner will even tell you attempt. They say attempt. So enjoy it like a story. That's why I usually tell people, enjoy it like a story and flow along. Enjoy it like a story and then flow along with it. So for any other person there, can you give me the gist of this question based on what you heard? Let me hear from others. Hello?
Like every other person is not on the call.
Good evening, sir.
All right, good evening.
Yes, sir. I think what the question is trying to let us know is that there are two divisions. So they have been using our balance scorecard, and the manager and the chief executive officer is ready to know more. So they want to go further to another type of our performance performance measurement instead of the one they have been using before. And here we can see that they have two divisions. So division X and Y, and they have a percentage for each of the division for their capital employed.
Okay.
So I think that is all.
Any other person? Any other person? Okay, let's proceed. B, determine both the return on investment and residual income of the new investment for each of the two divisions. Comment on these results and take into consideration the manager's view about residual income. So let's start with the return on investment. Return on investment. So let's look at division X. We know that our return on investment is equal to what? Profit all over capital employed times what? 100%. And from the question, what's our profit? Yeah, you have a net profit margin. You have a net profit margin of 30%. So profit will be my net profit margin multiplied by what? My revenue, because margin, profit margin is on revenue, multiplied by my revenue. So that gives me what? 30% of what? 46.4 million. Please calculate.
That's 13.92.
13.92.
Yes, sir.
13.92 million. And also, we need to know what our capital employed. So our capital employed for division X is what? 88 point what? 0.2. So I will know that our capital employed, which is the capital required for the investment, is 88.2 million. So ROI for division X will be what? 46.4 million over 13. Sorry, over, what did I do? 13.92 million over 88.2 million times 100. Let's multiply.
Is it multiplied by 100%?
Multiply by 100%.
15.7823. 15.7823.
15.7823. 15.78. 15.78.
10.78%. So that's that for X. ROI division Y will be, we have to know the profit for Y. So profit for division Y is equal to the net profit margin of 35% times what? 28.1 million. What would that give us? Knowing fully well also that the capital employed,
That's 9.835.
9.84. Oh, 9.84 what? Million. Am I right?
Yes.
All over capital employed, which is equal to what? 46.0 million. So this is all over what? 46 million. Can you see how I'm putting the Naira sign? When you're in the exam, you don't just say this thing like that. Please, let's calculate. So ROI for Y,
That's 21.380.
21.38%. Any question? Also, for the residual income,
Please scroll down so that I can write, please.
all right. Let's make it fast so that we can. Can I proceed?
Yes,
Yes,
please.
sir.
All right. For the residual income, we know that residual income is equal to what? Profit minus inputted cost of capital. Where your inputted cost of capital, where inputted cost of capital is equal to capital employed multiplied by what? Your cost of capital. So for division X, we already know our profit. So what is the imputed cost of capital? The imputed cost of capital, or what we call imputed charge, is our capital employed of 88.2 million multiplied by what? What is the cost of capital for division X? It was actually I read to us. So from what you read, what do you think is the cost of capital?
15%. Or yes, 15%.
15%. So let's multiply. Let's calculate. So I'll say that residual income
13.1.23.
13.23 million. So I'll say that residual income is equal to, what is the profit we derived?
$13.92.
13.92 million minus 13.23 million. What does that give us?
0.69.
0.69 million. What about for division Y? Division Y. Our imputed cost of capital will be 46 million times 15%. What does that give us? So our residual income is equal to
6.9.
6.9 million. So what's our residual income?
That's 19.84. That's the profit. Minus
19.84 million minus, this person is just going out and coming in, minus what? 6.9.
6.9.
And what does that
That's
give?
12.94. 12.94.
That residual income, what did you say is the profit?
The profit is 9.84. Sorry.
9.84. Okay.
Yeah, 9.84 minus 6.9. That's 2.97.
0.96.
2.97.
Any question? Any question?
No, from my end.
Any other person?
Let's go forward, sir.
What do you say?
I said we should go on, sir.
All right.
Sir, we've not commented on it.
Don't say we should go back. Okay. We've not commented on it. Oh, yeah, give me your comments. Comment on the results. How will you comment on the results? Let me even see your. This is the calculation for the person that asked for it. Is this the right place to be? Or I should move up? Okay, comment on the result. Oh,
Is it based on the residual income or based on the division, on the
when they say comment on
RO?
the results, comment on what the figures that you got.
For division Y, for the residual income. I don't know. I don't know how to comment on it. I think it's a better measure of a company's performance for division Y because it gives a higher return on investment. That's what I can say.
Okay. What is the current return on investment?
Sorry, can you go back to the question?
What is the current return on investment for the company? Look at it. Read this part.
18%. Yes, 18%.
18%. Now look at the return on investment for X and Y. What can you say about it in comparison to that?
Okay.
Historical was
Yeah,
18%. Okay.
That
division Y is a better measure in terms of returns.
It's not about
Because
division Y. It's not about division Y is a better measure.
division Y has higher percentage compared to division X as they get more profit.
Read here again.
the cost of capital as both
No,
division.
look at what I.
Each division is currently considering the following separate investments.
Now, if they are
So
considering separate investments, each of them are considering separate investment. Now, based on the return on investment, that is the historical return on investment, as given the question, and what we are generating now, what can you comment about the two?
based on the historical value, historical
Okay, what's ROI for X? Let me give us the
ROI for X is 15.78%.
10.78%. What's ROI for Y?
21.38%.
It's 1.38%. Okay, let's write. The current return on investment of each division is 18%. The current ROI of each division is 18%. The managers of division X will likely reject any proposal based solely on ROI. The managers of division X will likely reject any proposal based solely on ROI as the division X investment only has a ROI of 15.78%. Are you there? Only has
Yes.
the ROI of 15.78%.
compared to
The effect of this, the effect of this, the effect of this proposed investment, the effect of this proposed investment will be a reduction, in the ROI of division X, will be a reduction in the ROI of division X by 18 minus 15.78%. That is what? If you deduct 18 from 15.78.
0.7.
0.7. 15.78 minus 18%. 15% minus 18. 15.78 and 18% minus 15.78%.
2.22.
So that's what you put there. It will result in a reduction of the division X return on investment by 2.22%. Let's proceed. The managers of division Y are likely to accept the investment as it has the ROI of 21.38%, as it has a ROI of 21.38%. This investment would increase the ROI of division Y. This investment will increase the ROI of division Y by, find the difference.
3.3.
3.38%. Increase the ROI of division Y by 3.38%. Let's proceed. Division Y has a more LDRI, that's a more LD residual income, unlike division X. Unlike division X. ROI cannot be used solely as a decision tool by the organization. ROI cannot be used solely as a decision tool by the organization, as this would lead to a lack of goal congruency. As this will lead to a lack of goal congruency.
Go what?
Goal congruence. Goal congruence between division S and the company as a whole. Can we proceed?
Yes.
May 2015, question 3.
Why don't you answer the question on the balance scorecard at least so we have an idea?
When you get to that aspect, anybody taking it will give you that. So I'm only restricted to what I'm taking you for now. Is it clear? Is it clear?
Yes.
Question 3. Packets. Can someone read for us?
Packers is a division of an automobile group that has 5 years remaining on a leased premises in which it sells assembled motorcycles. The management is proposing an investment of 48 million on immediate improvements to the interior of the premises in order to stimulate sales by creating a more effective selling environment. The following information is available. 1. The expected increase in revenue following the improvements is 40 million per annum. The average contribution to sales ratio is expected to be 40%. 2. The cost of capital is 16%, and the division has a target return on capital employed of 20% based on the net book value of the investment at the beginning of the year. 3. At the end of the 5-year period, the premises improvements will have a new residual value. 4. The management staff turnover at Parker's division is high. The division's investment decisions and management performance measurements are currently based on the figures for the first year of their proposal. In addition to above information, there is an alternative proposal that suggests a forecast of the increase in revenue per annum for the premises improvement as follows. Year 1, 2, 3, 4, 5. Increase in revenue 56 for year 1, 40 for year 2, 40 for year 3, 24 million for year 4, and 16 for year 5. All other factors are expected to remain the same. Required. A. Prepare a summary of the statement of the management's investment proposal for year 1 to 5, showing residual income and return on capital employed for each year using the straight line method depreciation. 2. Comment on the use of the figure from the statement in A above as a decision-making and management performance measure. Praise the Lord.
Who is that? Okay. Let me give us one cheat. In case you are practicing on your Pathfinder, or you find yourself in the exam hall, whenever you want to approach or read a question, you can start from the required. So if I want to read this question 3, I will just start with the required first. I say A, prepare. So when you read from the requirements, that is, you read your A and B requirements, you now go to start reading the question from the top. Because the essence of doing so is that you would have had a view of what the examiner wants you to do. So as you read from the top, after you read the requirements, you now begin to gather information in relation to that A and B. And by so doing, you won't necessarily have to go to the question like up to 3 times or 4 times again for you to be able to understand. As you read along, you'll be getting understanding of it. So A, prepare a summary of the statements of the management investment proposal for year 1 to 5, showing residual income and return on capital employed for each year using a straight line depreciation method. All right, let's proceed. What's the name of the company? Packet.
Packet.
KEX.
SK. Abi?
Okay. No worries, understanding that matters. So you can say Packers statement summary. We said for 5 years. So I'll come here and say year. I have year 1, 2, 3, 4, 5. I hope this takes everything. Let me minimize this. 1, 2, 3, 5. And our major focus is on what? Showing the residual income and return on capital for each of them. And so before we can approach residual income or return on capital, whichever way we choose to follow, what are the things you must take note of? You must take note of the fact that we need our net profits. Yes or no?
Depreciation.
Yes or no? Yes or yes?
Yes.
So what are the components you need for you to be able to achieve getting your residual income and return on capital employed? What are the components you need?
Our net profit.
Okay.
We need the capital employed.
Yeah.
You
Yes,
mean
and the
that
cost of capital.
if
We need to know the cost of capital. Yes.
need to know
We need to know in a case where we are not given a straight figure for the profits, so we have to get use the revenue times the net profit margin.
Okay. So that means I can come here and say, for me to get my profit, let me go back to the question of this thing. Okay. The following information is available. The expected increase in revenue following the improvements is 40 million per annum. And here, the management is proposing an investment of 48 million on immediate improvements to the interior of the premises in order to stimulate sales by creating a more effective selling environment. So this is a capital project. Yes or no? This is a capital project. Do you agree with me?
Yes.
yes, investments.
Yes, it's an investment. Yes, it's a project. A project is an investment. They go hand in hand. So, based on information 1, the expected increase in revenue following the improvement is 40 million per annum. That is, after they've done the improvement, what is expected? They're expected to get what? 40 million per annum as sales revenue. So the average contribution to sales ratio is expected to be 40%. And this average contribution to sales ratio is what we can call our net cash flow. Is what we can use to derive our net cash flow. Now, at this point, for those that were in CVP analysis class, the contribution to sales ratio, what do we call it? CMR, right? Or CS ratio, or PVR. How many of us remember? Or you've used it to eat fufu?
Cost
That's
volume
contribution
profit.
over sales.
All of you have forgotten.
Contribution per
CS ratio.
unit over sales in units.
It's not sales in unit. Selling price.
Selling price, sorry.
So you see, even on the day of exam, some people will not still remember how to calculate contribution. And that aspect is always dangerous. So, you not get to the exam. You don't know. Contribution is a central topic when it comes to performance management. So at this point, one thing you must take note of, at the start of this investment, are you with me?
Yes.
At the start of this investment, we said that the opening investment, we have opening investment. Opening investment, which is what? 48 what?
Million.
48 million.
So let me come here and put a million. 48 million. And then here, I'm going to have my net cash flow or contribution. And how do I get my net cash flow contribution? Recall that they said it will result to an expected increase in revenue following the improvement is 40 million. So that means revenue will be 40 million once it is completed. And my sale contribution to sales ratio is 40%, which is 0.4. So if I say 0.4
Times 40 million.
0.4 is equal to C all over 40 million. That is contribution all over sales. What will my contribution give me?
16 million.
16.
16 million. So this is the net cash flow from it. That is, when I say net cash flow, it has been able to factor in the cost of, that is, including the variable cost. You know, from revenue, this 16 million now, which is contribution, means we have factored in variable cost into it, and we are able to know our net proceeds from it. Yes or no?
Yes, sir.
So I come here and say 16 million each. 16 million for 5 years.
Operating investment to 48 million for each.
Okay, it's proposing 48 million on immediate improvement. So let's move on. After the net cash flow, I'll say less depreciation.
How many years?
So that I can get my net profit. And how do I derive my depreciation?
Cost minus cover.
At the end of the 5-year period, the premises improvement will have a new residual value. Do you have anything relating to depreciation here? Do you have anything relating to depreciation here?
No.
Let's check very well. I'm coming.
There's no depreciation.
Straight line depreciation method. Requirement A.
Straight line depreciation method. That means there must be a figure here for depreciation.
We're only given the number of useful life, which is 5 years. And what's the cost minus? What's the residual value?
Okay, we are given the number of useful life, which is 5 years, and they said that what? It will have a new residual value, that is no scrap value. So what will be our depreciation for the first year?
Sorry, where did they state that?
Look at additional information 3.
Okay, 3. Okay.
Additional information 3. Since it is on a straight line, we say that for the first year, we have 48 million divided by 5. Am I right? So 48 million
Yes.
divided by 5 give us what?
9.6 million.
9.6.
So I come here and say 9.6. And then because this is for an investment, so it is assumed that that investment has started, that there have been an improvement on the leasehold assets. That means in year 2, my investment, the value of that investment will be 48 million minus 9.6 million. What would that give me?
38.4.
38.4. Then 38.4
Yes.
minus 9.6. Since it is on a straight line, it's not reducing. So 9.6 again. 38.4 minus 9.6.
28.8.
28.8 minus 9.6 again.
19.2.
19.2 minus 9.6 again.
9.6.
9.6. Can you see that it now became the value as at the end of that, or end of the useful life? So let's proceed. So when we subtract this depreciation, when we net it off, we get our net profit. So what are you subtracting now? The net cash flow, 16 minus 9.6. Oh yeah, oh. Oh yeah, 16 minus 9.6. Let's calculate.
54.4. Should be 48 plus 16 minus 9.6.
Oh, this 48 is fixed on its own. That's not what.
Okay.
16, the net cash flow is
6.4.
6.4. So we have 6.4 all through.
Wow.
So for us to ascertain residual income, let's say we want to calculate residual income. We say it is profit minus what? The imputed cost of capital or imputed charge. So we say less imputed cost of capital. And this imputed cost of capital, what will it be? For year one, what is the value of the investment in year one? The proposed investment, what is the value?
56.
Yeah, 156.
It's not 56 now.
40.
How much was invested?
40.
48 million. Multiply by, what is the cost of capital?
16%.
20%. Abi? Oh, 16%. Sorry.
16%. So what's the value?
7.68.
7.68. So I come here and say 7.68. Year two, what is the value of the investment in year two? We also do for year three. You pick that figure in year two on that summary under opening investment. What's the figure you see under opening investment? I don't want to go up.
38.4.
38.4 million. Multiplied by 16%. What does that give us?
6.144.
6.144. Year three, what do you have there?
28.8.
28.8 multiplied by 16%.
4.661.
4.61. Year four.
19.2. 19.2.
19.2 multiplied by 16%.
3.07.
3.07. The 5. What is it divided here? 9.6
9.6.
multiplied by 16%.
1.54.
1.54 naira, right? 1.54 million.
54.
Something like this. So I'll go up here. So you can give me the figure now.
7.68, 6.14, 144.
Hold on, 7.68. Oh, I'm repeating
You've done that.
the next one.
6.14,
6.14. Go on.
4.61,
4.61.
3.07,
3.07
0.54.
and 4.54. Is it 4.54 or 1.54?
1 point, 1 point.
1.
1.54. All right. When you subtract this, this will give you your residual income. So what's the residual income?
The first one is minus 1.28.
Minus 1.28. The next one,
That's 0.26.
0.26.
1.79.
1.79.
3.33.
3.33.
4.86.
4.86. Next one, return on capital employed. For the return on capital employed, simply say, for year 1, the profit of 6.4 divided by 48 million times 100. What do you have?
The profit 6.4.
Divided by 48 times 100.
Divided by 48. 13.33.
13.33%. For ROC, you put your percentage at the back. You don't just say 13.33, there must be percentage. So let's move on.
What do you say we should calculate? Sorry, ROC.
Yes, the profit divided by the capital employed. That is where you have the opening investment for each of the years. So for year 2, 6.4 divided by 38.4.
22.54%.
What do you have?
22.54%.
We dividing. Oh, what's this one?
6.4 divided by 28. 38.
38.4.
6.4.
That's 22.
Oh, sorry, 16.67.
16.67. Go on. Divided by 28.8.
22.22%.
22.22.
Yes.
Go on.
33.33%.
33.33%. And then the last one.
Divided by 9.6. 66.67.
6.67%. That's all to the question, 10 marks.
Wow.
So if you see it in the exam, jump
Wow.
on it. I think the previous one too that we did, the mark 2 was somehow okay, Abi. For that question 5, I don't know how, I didn't check how many marks was allocated to that.
Wow.
Let me see. Is if you don't know it, that it's become something else to you. Once you know it, you see that everything that we need to solve this question, if you observe my mark where I marked, you can say I marked something here. Yes or no?
Yes.
You can say I marked something here. These are where the things you need to solve the question. You see that in this question 5, we are making use of this figure, 15%. We are comparing with 18. So all these things, that's why I said you must read the question like a story to get all the points there. And I advise that you first of all read the requirements before you now go to the body of the question to read the main question. So you can see this one. Okay, the A is 8, this one 7. Can you say 7? This other one here, 3 marks and 10 marks. But when you look at it from the surface, it's like one hard question, Abi.
Yes.
That's just the issue there.
So we're not going to make use of the 56 investment and all that we have for all the years.
The 56.
Yes, I mean the increase in revenue that we have for each year.
Okay, look at something. Read from this part.
In addition to the above information,
Okay.
there is an alternative proposal that suggests a forecast of the increase in revenue per annum for the premises improvement as follows. Okay, alternative.
There's an investment proposal. There's an alternative. Which one were you told to calculate in A?
Sir?
There's an investment proposal and there's an alternative. So which one were you told to calculate in A?
The investment proposal, the real investment, not the alternative.
Good. Go to C.
Okay. Calculate the residual income and return on capital employed for the year 1 using the alternative proposal. Okay.
Can you see now?
Yes. Okay, using the alternative. That one is the real investment. Okay.
Can you see now? That's where this place now come to play.
Okay.
But meanwhile, the question says in year 1. So for that C part,
Okay, for the real investment.
for that C part, calculate the residual income and return on capital employed for year 1 using the alternative proposal. So for question C, for year 1, you didn't say year 1 to 5. You didn't say year 1. So I repeat the same thing. Opening investment. What's the opening investment?
48 million.
48 million. What's the next thing that follows? The net.
Net cash flow.
And what's the net cash flow? How do we calculate it now? Based on this alternative proposal.
Yes.
Sorry, I don't understand what we are trying on capital employed for year 1.
You're the one that read it to me now.
It's Victoria, not
It's
Shadi.
not me. It's not me.
Why are you people denying? Okay, let's move on. In addition to the above information, can you see it?
Yes, sir.
Which above information are they talking about? What we have read earlier on, right?
Yes, yes.
So there's an alternative proposal that suggests a forecast of the increase in revenue per annum from the premises improvement as follows. That if there's an alternative proposal, this is the increase in revenue: 56, 40, 40, 24, 16 million. So that means if we are to now calculate the residual income and ROC for this alternative proposal, we are looking at it that this revenue, this alternative proposal, will not just give a straight revenue, just like we have 40 million in the previous one. It will give different revenue: 56, 40, 40, 24, 16. So what do? We are only looking at that of year 1. So what is the net cash flow of year 1? Recall, what's the additional information that we have in relation to revenue? Additional information 1, what did you say?
We can't see it.
I thought you people have it down.
So what?
I'm coming. Additional information 1.
The expected increase in revenue following the improvement is 40 million per annum. The average contribution to sales ratio is expected to be 40%.
So this 40 million is for the project itself. Then the expected and the alternative proposal, what's the revenue that it's supposed to give us in year 1?
56 million.
56 million.
56 million. And what is our CS ratio from the additional information?
40%.
40%. Our CS ratio is 40%.
15 million.
So what will be the net cash flow?
Okay, 56 divided by.
You say 40.
22.4 million.
So that's 22.4. $22.4 million. Okay. After that, what was the next thing we did? We say less depreciation. And what's the depreciable amount? 9.6. That's what we calculated before, right?
Yes.
So, taking this into consideration, what would this give us? 22.4 minus 9.6. You don't have anything to do with the 4.8, with the 48 million.
$12.8
12.8.
million.
For us to get our residual income, we have to less what? Less interest. Interest on capital. And what's the cost of capital? The cost of capital is 16% now.
Yes.
So 16% of 48 million. That's for year one. What would that give us?
$7.68.
7.68. Subtract.
$5.12.
5.12. That's our residual income. And what about our return on capital employed? Our profit, which is 12.8 divided by 48 million times 100. So what will that give us?
$266.6.
268.
266.6.
266.6.
No, 26.6. 26.66.
26.66 or 67.
We have 100 in front now.
No, 12.8 million divided by 48 times 100%.
Okay, 26.6.
That's 26.7%. That's all. Any question? Any question? The way that person is punching a calculator, the calculator would have known you before your exam. It's good. I know some people, they don't even have calculator in this class. It is on the day of exam. They will now run to that the ICANN exam center in my 2. At the front of that woman that sells calculator, they will now start buying calculator of 4,000. If they want to catch you in your village, you should now buy the calculator and enter the exam hall. It's in now off. What will you do? You will start to borrow. And I know many of us can calculate from our head, right?
Maybe.
All right, so that's that on performance measurement. I'll stop here for today. In our next class, we'll dive into relevant cost. And relevant cost is a key topic in performance management because most of the time, your question 1 do come from there. We are going to look at past questions too. I'm going to spend time on that topic. It might even take us up to maybe 3 weeks if possible. I pray we don't use the whole of September to cover it, but it's worth it because of its complexity. So till we meet next week again, let's prepare. And those of us that we do not talk in class, that are just behind, well done. I know that by the time we start the class on relevant course, you will talk, whether you like it or not. Because by the time you hear grammar, the grammar will force you to talk. Hope we enjoyed today's class. And is it an eye opener based on the past question? Let me hear from us.